All right, 12631 Chess and Wine here. It is Friday afternoon, November 19th, 2010. You're looking at a chart of the SPY, the actively traded ETF for the S&P 500 here, the SPY. But it is not real time. It is from the fall of 2009, the summer slash fall 2009, early winter. That period of month from August to December. And the reason why I'm showing you this is to show you kind of the essence of an uptrend. If you remember, we had that false head and shoulders bottom from the summer of 2009. Remember, we bottomed in March of 2009, sharp rally, followed by, again, false breakdown here. And we had that several weeks to close out the summer of prices screaming higher before we consolidated a little bit. And then what's interesting is, this is really what I want to get down to business and talk to you about is we had a period where we had a steep uptrend here without even coming close to the rising 20-day moving average. We came a little bit below it. We breached it. We consolidated a little bit, and then we moved back up actually to new highs. Then we had another period in September, coming into September, where we pretty much did the same thing. We came below it, below the rising 20-day moving average. We dipped below it, we consolidated, we moved back up to new highs. Then we did the same thing here around Halloween, around late September, except we did it with the 50-day moving average. It came just below it and then dipped back up, made slightly new highs. So this is really, during an uptrend, it's extremely important to understand, my point is this, the overarching trend. In other words, the overall pattern is still a move towards generally higher highs and generally higher lows here. And even when we come down and make a marginal new low right around here in late September, you can see we still rallied back up to new highs. So the point is that in uptrend and in downtrend, but trends can last longer, much longer than, I say this all the time, than I guess rational thinking traders think is possible. And in other words, in retrospect, in hindsight, everything's 2020. But when we did gap down, when we had a steep run for this long, and then we finally gapped down below the 20-day moving average, even on a little bit of an uptick in selling volume, it was so easy to become bearish. I mean, how everyone, not everyone, but it was very easy to just say, you know what, it's been a nice run, now it's over with. That would have been the rational thinking, calm, intelligent response. But instead, look what would have happened to you if you decided to get bearish down here and start either you move to all cash, or you worse yet, got very aggressive on the short side. Not only would you have been wrong, but the market would have gone to new highs, and maybe you would have gotten some redemption if you held down here. But that would have been a painful ride this whole way up, the consolidation. So the idea is that even though you precisely lose a moving average like the 20-day moving average, that doesn't mean it's a case to get bearish. Remember, moving averages are merely reference points. In the general area of the 20-day moving average, in the general area of the 15-day moving average, you're looking to see how the market reacts. It's negotiating these averages. And obviously, the bulls won each of these meetings with the averages. So I think that's something you really want to keep in mind as we're looking at the market that we're faced with today. I mean, you look. Let me scroll this up here to real time. We're looking at a market here that, again, had a very steep uptrend here, then came down, lost the 20-day moving average, and people said, you know what, that we're definitely going to this 50-day moving average, we're definitely going to this 1150 level. Well, that's not always the case. I mean, right now, we're still negotiating with this 20-day moving average. We're coming to terms with it, even though we lost it earlier this week, and even though right now we're slightly below it. It's at 1198. Price is currently 1197. Like I said, we're coming to terms with it. So you don't want to be too conclusory, especially on the bear side. You don't want to jump to conclusions and become a bear just because you lose a 20-day moving average after a steep uptrend. If anything, that's kind of been my recurring theme here. If anything, it should be looked at as a dip buying opportunity. You don't want to give up too early on the trend. You certainly don't want to become too bearish during an uptrend.